It's interesting to note that over the past month or so, the bond yields have been largely unchanged, and that's despite fairly strong economic data and a relatively hawkish Fed. If anything, over this period, over the past month and a half, the likelihood of Fed tightening has actually increased. So why haven't bonds moved higher? Well, uh, the chart we're just looking at in front of us at the moment just shows the US 10-year Treasury since 2009, and I guess the initial sell-off, the sell-off in the bond market was on its way before the Trump election, but really accelerated post the election victory of Donald Trump, but has since been basically sideways. So it essentially achieved that 2.4, 2.5% level in the early part of December, and ever since then we've basically been in a very narrow band. If we try and think about what's happened to Fed funds and market pricing or expectations of the Fed funds rate. So I've just added the Fed funds rate there in red. If we look at where the implied expectations were prior to the election, we can see those in gold. So they sort of had 1% by sort of early to mid 2019. By December 7, and that's the period over which really all the action occurred in the bond market that month, we have the green line being the upward adjustment in the implied Fed fund futures. So that was something like 50, 60 basis points over the medium term. But as we've seen over the past month or so, if we go out to Feb 15, we look at the expectations there, they've moved higher. So they've continued to move higher, not by nearly as much as that sort of December period, but nevertheless moved higher, yet bond markets haven't really sold off any further. What about in terms of economic activity? Well, if we look at the ISM index, and the most recent reading we had was 56, you can see the relationship, certainly since the Great Recession, the relationship between the ISM index and the bond market has been particularly strong. There's been the odd period where they've diverged, but by and large, it's typically followed patterns in the overall economic activity index. Now, the ISM has picked up even further up to 56. And based on regional surveys, one might expect it to increase again in the current month. Yet the bond market, as we've already noted, has not really sold off. So what's going on? Uh, one one theory, I suppose, is that bond market is already, or the investors are already positioned for the sell-off. And if we look at just a technical indicator, a relative strength index, you can see that the bond market on that move to 2.4, 2.5 become oversold and has since moved back in. But there's got to be other reasons, and we'll explore some of those. So perhaps the reasons are more structural in nature. So if we go back now to an analysis, I suppose, of a useful indicator for understanding what fair value might be in the bond market, one is to approach is to look at nominal GDP growth. So if we build up the nominal GDP growth expectations for the US, and we can do the same exercise for Australia, but if we look, what I'm showing here at the moment, this is labour force growth, 10-year annualised growth in the labour force. So you can see how that's been slowing from sort of 2.5% down to around about 0.2, 0.3 over the last 10 years, and that's is projected to be very weak over the coming 10 years. If we add to that a measure of productivity, we'll add that in terms of in bar form, and you can see there now. So now we've got productivity being the red bars. Now together those two should give you a reasonable estimate of what real potential GDP growth is, and that is what I'm going to show you there now. So that's the gold line. So it is a reasonable approximation of underlying trend real GDP growth. You can see there that that's slowed from around about 3% to somewhere around about 1.5% over the past 10 years. Now, if we want to derive some sort of measure for underlying nominal GDP growth, so if you add an implicit price deflator on top of that to get an idea of nominal GDP, we add that there, the green bars, and then we should really then be able to estimate or give an expectation of what nominal GDP growth, and that's the purple line that's come up there now. So that's how we've built up, I guess, the building blocks of nominal GDP growth. So why is that important? Well, I think it provides a bit of an anchor point for bond yields. It also provides an anchor point for earnings, long-term earnings growth expectations, and also Fed policy. But if we think in terms of bond market, if I pick up the US Treasury, that's now in that light purple line. You can see how that's broadly matched nominal GDP growth over the long term. Certainly during the 1980s up till about 2000, 2002, bond market generally traded plus or minus nominal trend GDP growth. But since 2002, we've seen quite a break below, where bond yields have traded 1 to 2% below trend nominal GDP growth. So if trend nominal GDP growth once again becomes an anchor point for valuation for bonds, then you might suggest somewhere around about 3% is a realistic target. So essentially, low levels of underlying trend nominal GDP growth suggest to us that bond yields should generally stay low in a structural sense, and 3%, possibly 3.5%, provides a reasonable starting point for bonds, plus or minus 50 to 100 basis points either side. So that doesn't give you I suppose, a lot of precision around where bond yields are going. But in the meantime, in the near term, we have to then be focusing on what's actually happening to actual GDP growth. And this is even more interesting in light of the proposed growth targets of the new US administration. So if we look at, so what we're showing here on the chart here is what is seen as potential GDP growth in the US, as we were discussing earlier on. Once upon a time, 4%, slowed to about 3% during the sort of 70s and 80s, and since fallen away into that 1 to 2% band. Currently, let's say around about 1.7%. If we add on top of that the actual GDP numbers in recent times, that's the red line now, and you can see that over the past 5 years or so, 5 or 6 years, growth has been very moderate, but it's been above potential. But it's been allowed to be above potential because of the significant output gap that we had in place already. So if I add the output gap now is on the right-hand scale, they're the gold bars. So during the Great Recession, the output gap widened to about 6%. It's since, given growth has been above potential for the past 5 or 6 years, it's slowly whittling away that slack in the US economy. Now, putting it into context of today's discussion around the likely direction of bond yields and Fed funds in light of Trump's proposed policies and growth targeting of somewhere around 3, possibly 4%, it then raises the distinct possibility of putting or removing this output gap over the next 1 to 2 years. And if that's the case, then that would start to have implications for potentially for inflation, and then therefore for Fed funds rate and also for bond yields more generally. So it certainly appears that there's some structural factors behind the low level of bond yields. Underlying growth of somewhere around about 1.75, nominal GDP growth 3, perhaps 3.5%, sort of suggests that any sell-off in bonds is likely to be limited. However, as we know, there are some cyclical risks, and they largely revolve around the policy platform put forward by the Trump administration, seeking to grow the economy upwards of 3%, which would be, 1 to 1.5% above what is deemed to be the potential growth rate. And what that means is that the output gap, as we can see here, shown in purple bars, would quickly narrow from the current sort of 1% gap, would quickly move into neutral to even slightly above capacity. And that's important, obviously, because as we've seen in the past, the black line shows that whenever the US economy has been growing above its potential, policy has generally been tight. Now, the black line measures the actual real Fed funds rate relative to the neutral estimate. So a positive number, it only ever gets about 1% above, certainly since the early 90s, above neutral. But if neutral at the moment is measured at the present time is seen to be around about 2.25% nominal, then that would suggest cash rates moving, or Fed funds rate moving up to around about 3.25, 3.5 at the upper end. So there is a risk there that if the new administration is successful in implementing its growth policies, its growth-oriented agenda, then the Fed funds rate will have to return to a neutral position. So, and as I said, the neutral position for the Fed funds rate is estimated at the present time to be around about 2.25 in nominal terms. So there would appear to be some upside risk to certainly the Fed funds and the short rate of the market. There would appear to be some cyclical risks to the long end as well, although as we pointed out at the outset, the underlying structural factors that determine the overall level of bond yields are still quite low and not consistent with a very significant rise in bond yields. Thank you.